Something huge is building up in the crypto market, and most people have no idea what's coming. I strongly believe that billionaires and large institutions are preparing to push the prices of major digital assets to levels we haven't seen before, especially XRP. This isn't random buying or emotional trading. This is a well-planned, well-coordinated strategy that only becomes clear when you understand how the big players operate. When billionaires move, they move quietly, slowly, and in patterns that only make sense once you zoom out. And in today's video on BullionIQ, I want to show you the early signs of this movement so you can position yourself before the rest of the market wakes up. Welcome back to BullionIQ, the place where I break down complex financial shifts in simple English, and where I help you think like the people who actually control the markets. If you're watching this, stay fully focused, because what I'm about to explain is not speculation. It's based on data, institutional behavior, and macro trends that are already unfolding. I'm more than 80% confident that a massive wave is coming, and if you understand it now, you will be miles ahead of the average investor. The first clue is the aggressive buying happening from treasury companies. MicroStrategy continues to acquire Bitcoin at a scale that almost looks unreal. Bitmine just purchased nearly $500 million worth of Ethereum in one single buy. Ripple's acquisition of G-Treasury is even bigger news because it isn't just a crypto investment. It's an infrastructure move. This acquisition means trillions of dollars in global cross-border payments could run on XRP rails. That type of utility does not stay quiet forever. When institutional utility grows, price follows. Institutions always prepare before the public understands why. While all this buying is happening, public sentiment is completely opposite. Nearly 60% of Americans believe the country is already in a recession. Even though the S&P 500 keeps hitting new highs, gold and silver are breaking records, and crypto is seeing the largest silent accumulation phase in years. This disconnect is a classic sign of institutional accumulation. Whenever the public is confused and fearful, institutions quietly load up. As a professional analyst, I can tell you confidently that when fundamentals rise but fear stays high, the market is being accumulated, not sold. The second major clue is monetary policy. A new Federal Reserve chair is expected, and he's extremely bullish. He isn't calling for small rate cuts. He's talking about cutting multiple percentage points. If that happens, liquidity will flood the economy in ways we haven't seen since major historical expansions. The money printer is expected to return in 2026, and when that liquidity hits, assets like Bitcoin, Ethereum, and especially XRP could experience explosive upward moves. Hard assets rise first, speculative assets rise second, and utility assets like XRP often rise last but rise the most when liquidity expands. This is why institutions are accumulating now. They're not guessing. They're preparing for the liquidity cycle that always comes after tightening. Quantitative tightening officially ended on December 1st, and with a 94% probability of another rate cut being announced, it's clear the cycle is shifting. Billionaires always position themselves months before the public sees confirmation. The third clue is global adoption. Countries across South America, Europe, and even Argentina and the US are discussing allowing banks to offer crypto custody services starting in 2026. When traditional banks enter the space, trillions in capital become eligible to flow into digital assets, and institutions want to be holding their positions long before that happens. All these signals are pointing in one direction: preparation. Something big is coming, and the smartest money in the world is already positioning itself. The question now is not whether a major move is coming, but how early you want to be before that move starts. It's time to understand how they are orchestrating these moves. This is where most retail investors get it wrong. They see the market react, but they don't understand the mechanics behind it. The truth is, large-scale players don't just buy and hope the price rises. They move in very calculated steps, leveraging liquidity, macro events, and even public sentiment to their advantage. And XRP is positioned perfectly to benefit from this system. The first mechanism they use is timing liquidity cycles. Institutions track Federal Reserve policies, interest rates, and macroeconomic announcements months in advance. For example, the expected rate cut in the coming days is not a surprise for them. They already know quantitative tightening has ended, and with rate cuts incoming, liquidity will surge into the market. When this happens, asset prices rise. The trick is entering the market before the majority of traders realize it. Billionaires do this by buying quietly and in stages, avoiding sudden price spikes that could scare the market. The second mechanism is strategic accumulation in undervalued assets with real utility. Unlike meme coins or hype-driven tokens, XRP is tied to real-world transactions and cross-border payments. When Ripple's team acquires infrastructure companies like G-Treasury, they're not just speculating, they're building demand. Trillions of dollars in cross-border payments running on XRP automatically create scarcity because more XRP is needed to facilitate these transactions. Demand grows, and with supply fixed, prices naturally rise. This is a textbook case of utility-driven price appreciation, something most retail investors fail to understand. Next, these players exploit public sentiment misalignment. Right now, many Americans think the economy is in a recession, even as GDP growth continues and the S&P 500 hits new highs. This fear creates opportunities. When the public is fearful, institutions quietly accumulate assets without driving prices up prematurely. By the time retail investors notice and start buying, the market is already in motion. This is one of the most powerful tools billionaires use. Buy when the market doubts, sell when it believes. Another method is cross-market influence. Billionaires and institutions don't just focus on crypto, they move across equities, metals, and other assets simultaneously. For instance, gold and silver are reaching all-time highs while crypto is quietly accumulating. By understanding the flow of capital across these markets, large investors can predict where the money will move next. XRP, with its institutional use case, is uniquely positioned to absorb this capital as part of a broader market rotation. Geopolitical events and policy decisions are another lever. Governments worldwide are gradually moving toward crypto integration in banking and payment systems. Argentina, the US, and even European countries are discussing crypto custody services for banks starting in 2026. When regulatory clarity emerges, trillions in institutional capital can legally flow into these assets. Early positioning by Ripple and other major players ensures that they capture maximum upside before mass adoption begins. The fifth mechanism is anticipating tech-driven growth, especially in sectors like AI. Much of the current US GDP growth is fueled by AI spending. Billionaires understand that AI, combined with liquidity expansion, can create temporary asset booms. They use these booms to maximize returns on assets like XRP. For example, as tech companies demand more computing power and transactions increase, demand for blockchain-based settlement solutions like XRP grows. Understanding these underlying drivers allows smart money to enter before the general market realizes the connection. Lastly, large players rely on psychology and pattern recognition. They study previous financial crises, such as 2008 and 2009, to understand market behavior under similar conditions. They notice patterns like job cuts, GDP fluctuations, and sector-specific growth. In 2025, despite job cuts and fear of recession, GDP is growing, tech spending is high, and institutional accumulation is strong. This combination signals a slow buildup that could culminate in explosive moves in 2026 or 2027. By recognizing patterns early, billionaires position themselves strategically for maximum profit. As a retail investor, understanding these mechanisms is critical. It's not about guessing which coin will pump next. It's about understanding why certain assets will rise based on liquidity cycles, institutional behavior, and macroeconomic triggers. XRP is not a speculative token in this scenario. It is a structurally advantaged asset because it benefits directly from these orchestrated moves. If you position yourself correctly, you can ride the wave alongside institutions rather than after they've already made profits. It's time to focus on specific indicators that tell us when XRP and other digital assets might move next. These are the signals that professional analysts like myself watch every day, and if you pay attention to them, you can make much more informed decisions than the average investor. Understanding these indicators is the difference between riding the wave and watching from the sidelines. The first key indicator is institutional treasury buys. When companies like MicroStrategy, Bitmine, or Ripple make large purchases, it's a signal that these assets are about to be in high demand. Unlike retail traders, these institutions don't make impulsive decisions. Their purchases are backed by research, macro analysis, and strategic timing. For example, Ripple's G-Treasury acquisition signals long-term demand because it increases XRP usage for cross-border payments. As adoption grows, the price naturally follows, creating opportunities for early investors. The second indicator is monetary policy changes. The upcoming Federal Reserve rate cuts are a perfect example. When rates are lowered, liquidity enters the financial system, giving investors more capital to allocate toward assets like crypto. With quantitative tightening ended in December and a likely rate cut imminent, we can expect a surge in market activity. Historically, these liquidity waves create a favorable environment for price spikes in assets that are already being accumulated quietly, like XRP. Another critical signal is public sentiment versus actual market data. Right now, a large portion of Americans believes the economy is in a recession, even though GDP is growing and the S&P 500 is hitting record highs. This kind of public fear is actually a bullish sign for professional investors. When the public is hesitant, institutions accumulate quietly without creating price spikes that would alert retail traders. This misalignment between perception and reality is exactly what allows early movers to profit substantially when the public finally reacts. The fourth indicator is cross-market trends. Successful investors never look at crypto in isolation. They monitor equities, precious metals, and other asset classes simultaneously. Gold and silver hitting new highs, combined with institutional crypto purchases, suggest a coordinated flow of capital across markets. XRP, with its utility in global payments, is positioned to benefit when money moves from traditional financial markets into blockchain-based assets. Following cross-market trends can help predict when XRP might see accelerated upward momentum. Geopolitical developments are also a major indicator. Regulatory clarity regarding crypto adoption, bank custody services, or cross-border transactions provides a roadmap for institutional capital inflows. Countries like Argentina, the US, and parts of Europe are beginning to create frameworks that allow banks to hold and manage crypto. Once this happens, the floodgates open for trillions of dollars to enter the market, giving XRP a strong foundation for massive price growth. Another factor to watch closely is technology-driven demand, particularly in sectors like AI and cloud computing. Much of current GDP growth is fueled by tech spending, and this spending drives demand for efficient transaction systems. XRP's role as a settlement layer for cross-border payments makes it a natural beneficiary. Companies investing heavily in AI, cloud infrastructure, or fintech will indirectly increase demand for XRP as they process more transactions on Ripple's network. This relationship between tech adoption and asset demand is a critical signal for predicting price moves. Finally, understanding historical market patterns is essential. By analyzing past financial crises and economic cycles, we can see recurring behaviors in markets during liquidity surges or downturns. For example, during 2008 and 2009, large institutional players quietly accumulated undervalued assets before the public realized the opportunity. We are seeing a similar trajectory in 2025 with rising job cuts, strong GDP growth fueled by technology, and significant treasury-level accumulation. Recognizing these patterns allows us to anticipate potential explosive moves in XRP well before the mainstream reacts. Tracking these indicators doesn't just tell you that a price move is coming, it tells you when and why it will happen. This is what separates professional investors from casual traders. By watching treasury buys, rate changes, public sentiment, cross-market flows, regulatory developments, tech-driven demand, and historical patterns, you create a roadmap for potential market behavior. XRP is uniquely positioned to benefit from all of these factors simultaneously, making it one of the most promising assets to watch as we move into 2026 and beyond. This is where strategy and timing become just as important as understanding the market itself. Following the movements of billionaires and institutions without a plan is risky. To truly benefit, you need a structured approach. The first step is positioning yourself early. As we discussed, institutional purchases, upcoming Fed rate cuts, and cross-border adoption are signals that the market is about to experience a liquidity surge. Early positioning means entering the market before these events fully impact prices. This requires patience and discipline because initial moves may seem slow or stagnant. But remember, institutions never rush. They accumulate gradually to avoid driving prices up too quickly. You should adopt a similar approach, buying strategically and steadily rather than all at once. Next, focus on allocating capital wisely. You don't need to put all your funds into XRP or any single asset. Diversification across digital assets with strong fundamentals like Bitcoin, Ethereum, and XRP reduces risk while still allowing you to benefit from major market moves. Think of XRP as your utility play, benefiting from real-world adoption and cross-border transactions, while Bitcoin acts as a store of value, and Ethereum captures smart contract growth. This mix mirrors what institutional portfolios often look like and positions you to profit from different market dynamics simultaneously. Another key strategy is monitoring real-time market signals. Watch treasury buys, regulatory updates, and macroeconomic announcements closely. For instance, if a large company like Ripple announces a new partnership or acquisition, it's often followed by increased demand for XRP. Similarly, when the Federal Reserve signals upcoming rate cuts, liquidity enters the system and the market responds. Professional investors track these events and adjust their positions accordingly. Staying informed is not optional. It's essential for early moves and effective risk management. Risk management is critical. Even with all the data pointing toward a bullish scenario, markets are never completely predictable. Set clear entry and exit points, and be prepared to adjust your positions based on market behavior. Use stop-loss levels strategically to protect against unexpected drops. Institutions always calculate risk before making moves, and you should adopt the same mindset. This ensures that you can participate in the market's upside while limiting potential downsides. Timing is also crucial. Based on historical patterns and current market behavior, the full impact of institutional accumulation and liquidity waves often happens over months rather than days. This slow buildup allows for strategic entries and exits. By watching the accumulation phase, you can position yourself alongside institutions, capturing gains before retail traders flood in. Remember, retail often reacts late, which can mean higher prices for you if you enter early. Another important factor is understanding macroeconomic context. GDP growth, job cuts, AI-driven tech spending, and global banking regulations all influence crypto demand indirectly. XRP benefits when these factors drive cross-border transactions and institutional adoption. By connecting the dots between global macro trends and XRP's utility, you can make more informed decisions rather than following short-term hype. This is exactly how professional investors think. They invest based on trends that have real-world implications, not just price charts. Finally, adopt a long-term perspective while remaining flexible. This isn't about quick gains, it's about understanding the full market cycle. Based on current trends, we may see a gradual buildup in XRP's price through 2026, followed by a potential explosive move. And this mirrors historical liquidity-driven cycles, where institutional accumulation precedes large price surges. By keeping a long-term view, you avoid panic selling during minor dips and stay aligned with the broader market trend. Let's look at potential scenarios for XRP and the broader crypto market in the coming months and years, and how professional investors prepare for each outcome. Understanding possible outcomes allows you to react intelligently rather than emotionally, and it helps you align your moves with the actions of institutions. One likely scenario is a slow accumulation phase followed by a major surge. Based on the patterns we've observed, Treasury buys, Ripple's G-Treasury acquisition, upcoming Fed rate cuts, and global banking adoption, XRP could experience a gradual buildup in price through 2026. Institutions will continue quietly accumulating during this time, while public sentiment may remain skeptical or fearful. This creates the perfect environment for a price explosion once liquidity fully enters the market. By tracking accumulation, you can time your positions to maximize gains ahead of the crowd. Another scenario to consider is the impact of macroeconomic surprises. Federal Reserve policy, inflation reports, and geopolitical events can accelerate or delay market reactions. For example, if rate cuts happen faster or liquidity injections exceed expectations, XRP could move more rapidly than anticipated. Conversely, delays or unexpected restrictions could slow growth. Professional investors continuously monitor these macro signals and adjust their positions accordingly. You should do the same. Stay informed and flexible so you can react to changing conditions without panic. A third scenario involves tech-driven demand, particularly from AI and global payment systems. Much of the current U.S. GDP growth is driven by AI spending, which increases demand for fast, scalable transaction systems. XRP is well positioned as a payment rail for cross-border transactions. As AI-driven infrastructure expands, more companies will require efficient settlement systems, which directly benefits XRP. By understanding the connection between technological growth and crypto demand, you can see why XRP may rise independently of short-term market hype. It's also important to consider historical patterns from past financial crises. In 2008 and 2009, institutional players quietly accumulated undervalued assets before the market fully realized the opportunity. We are seeing similar dynamics today. Job cuts, fears of a recession, yet GDP growth and institutional accumulation continue. This combination suggests a slow buildup, followed by a potential explosive move. Recognizing these patterns gives you a roadmap for positioning strategically rather than reacting emotionally to market swings. Risk mitigation remains a key component in all scenarios. Even in bullish environments, unexpected events like regulatory changes, global crises, or liquidity shocks can impact prices temporarily. Professional investors always maintain protective measures, such as stop-loss levels or position adjustments, to safeguard against sudden moves. By adopting similar precautions, you can participate in potential upside while minimizing downside risk. Another consideration is timing exits and taking profits strategically. While accumulation is essential, knowing when to partially take profits can protect gains. For instance, after a major institutional-driven surge, prices may temporarily correct as retail traders react late. By planning exits in stages, you avoid selling everything too early or holding too long and risking a correction. This step is what separates professional investors from casual participants who often panic or miss opportunities. Finally, staying updated on institutional behavior, macro trends, and XRP adoption is essential. Follow announcements from Ripple, monitor Treasury buys, and track Fed actions. Regulatory developments in the US, South America, and Europe can significantly influence institutional capital inflows. By keeping these factors in focus, you stay ahead of retail sentiment and position yourself to benefit from coordinated market moves.